Hello, YouTube. There's a clear pattern on the NASDAQ or the QQQ, which shows a bullish engulfing monthly candle, which usually means that there has been some kind of a trap because there's a lower low and there's a higher high, but we're also closing over the previous monthly high. The NASDAQ is up nearly 20% on the year. It is in bull market territory over 305, and the S&P is not far off. So why does this matter? Well, it matters because we have a pattern here on the monthly, which is another psychology chart of where the bulls are. And yes, right now we're climbing the wall of worry. So there are things to worry about. But as we form higher highs and higher lows, we have to be very mindful of the pattern here. We also have increasing volume, and we have a lot of bear fuel since June of last year. The bears are unwilling or unable to relinquish their short, and they've added on about 10% more as we're pushing higher here. So there is definitely more fuel in the tank to fuel this move higher. In addition to that, odds for a positive April are also quite good. If Q1 is positive, April is positive 71% of the time. If Q1 is negative, April is positive 58% of the time. That really comes down to our seasonality chart, where for the first 3 months, instead of going only up about 1%, we're actually up a lot more. And as we're set here to go into March to April, the odds, again, seasonality tell us that we're likely going to go higher. And the positioning from that short report also tells us that. So we could be set for some continuation here before we pause and go sideways. What this has led to is a risk asset rally. Bitcoin up 71% year to date. NASDAQ up 20, S&P up 7. Oh my goodness. So what this really comes down to is big tech. Microsoft, Google, Apple, NVIDIA, Amazon. We got AI. We've got this big push happening. And why does this matter? Well, because we're right back here to neutral. So again, we buy fear, we sell greed, and we're right back in the middle. So what do we do as we're trying to get ready for a new month and potentially a big move? So we noted here, this is really what's going to drive the psychology for me. I do also have a bullish tilt or a bearish psychology chart, sorry. But I want to focus on this one because I think it really all comes down to the NASDAQ. And the reason I say that is because regardless of what chart this is, we're over the 50 MA, we're over the 200, we're in bull market territory. There's been a large period of consolidation where we go nowhere. We pushed off our 50 MA, and we also have a trap. That's by definition what an engulfing candle is, because at a certain part during the month, there was a lower low. The bears appeared to be correct. But by the time the candle closed, or the end of the month, well, they haven't won. And the reason why this is also really interesting is because I think the stat on the SPY or S&P is just that there's only like 2 times in the history of the markets where there are back-to-back positive quarters and it was a bear market. So is this time different, or are we just going to do the same old thing and we're just delaying the inevitable? That's what it really comes down to. So there's odds. We also have to keep in mind that the market does not do exactly what we want all the time. And I think what's happening with a lot of the bears is that the market is remaining irrational longer than they can remain solvent. So they might be right eventually. There might eventually be that move, but right now, this is a very painful trade. So as we look forward here to another headline, a bearish sentiment on stocks is the best thing the rally has going forward. Skeptics, cranks, disbelievers, the stock market is overrun with them. It may be one of the reasons equities keep rising, that wall of worry. Let's jump down to a few quotes here. Zero bulls out there, wrote Brian, right? Yes, that's pretty true. Part of me wonders if the trigger finger is starting to itch. Yes, the FOMO, as we're only in neutral right now. So prolonged equity gains add pressure on skeptics as well. Why? It's just what they know. It's what they've done. It's what they are used to. Cyclicality again, defensives. We've talked about that. Easiest way for me to try to understand what's happening here is by looking at RSP, and we look at a 12-month chart. And it's better now, but it's still a fat doji. We're up by 2% on the year, and we're going a whole bunch of nowhere because we have a doji pattern here. RSP is just equal weight S&P 500, which means every stock is equally weighted. It is not weighted like SPX, meaning that there's less tech focus. And when there's less tech focus, again, the NASDAQ right now is currently up by 20% on the year. That's like a lot. It's dragging the market higher. So that's what it really comes down to. There's one more quote here. It is the bears who are trapped and could fuel further gains in April. Again, that's Tom Lee. He's the resident bull, thinks we're going to go to 1 million, right? He's like Cathie Wood, but there you go. There's the quote. I think it's pretty relevant too. So NASDAQ 100 rally sparks bull calls. Why? Because we're up by 23% off the low. And We had a similar rebound last year, which proved fleeting. That was the top. So we have to be very mindful. And because we have a monthly chart to look at, it's very easy for me. I'm going to tell you all the levels to be mindful for at the very end of the video, but I'm going to go through both the bull and bear scenario at a very high level right now. But just before I do that, I'm going to ask you for a huge favor. If you're still watching the video, I would really appreciate if you could consider smashing that thumbs up and subscribing to the channel if you're enjoying the video. We put out videos every single day, and we will update you on the story next week, next month, and next year. Why? We love this. That's why we're called Stocks Today. Anyways, let's go through here and let's look at these two scenarios. So with what I laid out in about 5 minutes, let's look here to the bear case, because the bear case is still pretty strong, even if the price action is not confirmed. But I think positioning is off for the bears. So what the bears have going for them is fundamentals, but they don't have timing. They don't have the positioning. And right now, the momentum is not going for them. So they got the Fed, right? The Fed's helping them too, right? Don't fight the Fed. Fed is hawkish, even if they might be pivoting right now or pausing. So they got a pretty bad scorecard, but let's look at the chart. What is the rationale for remaining bearish right here, right now? You're going to note this pattern, which is a head and shoulders, and we have a threshold here at 315. Again, that 315 is more than 20% off the low, or where we both a bull market. So let's understand the reasons why this 315 is so important. We're going to delete everything. We're going to go to a 12-month chart, and here we go. Oh, it's because we're over the 2020 high. Yes. So on a very, very, very small candle time frame, this is like a head and shoulders, because we have our head going up to the all-time high above 400. We have our neckline here at about 31469, exactly 31469, sorry. So over 315, we cleared that. And the reason why this is significant is because the S&P did the same thing. Let's just bring my lines back, and we'll just make sure we don't lose those. Let's go to S&P. Let's remove everything, go to a 12-month chart. S&P closed out 2022 by sucking back up and then actually bull pivoting off of the 2020 high. So if the S&P did it, and it has banks inside of here too, remember, right? And it's moving higher. Can the NASDAQ do that too? Yes, I think maybe it can, even if it's only going to be temporary. So let's look at one more chart here, because if we go to QQQ divided by DIA, we're approaching the 1. And the reason why it's important that we're approaching the 1 is because it means that right now, tech stocks are outperforming the Dow. And because they are the current leaders, we need to see that leadership rotate over here to QQQ. If we get above 1, it means it is breaking out. And I've talked before about the pattern we saw setting up here. It pretty much aligns with Q3 and Q4 positioning, and now we're going into Q1 positioning. So is this going to continue, where we see outperformance from the Dow? Sorry, from tech versus the Dow, or are we going to see people fade what was working like they did at the end of January? Sorry, end of December going into January. I think that's a very important thing for us to keep in mind. And if now we understand what the bear case is, well, if we, again, now remove everything again, just to make it nice and simple, well, what do we have in this most recent action or the last couple of candles? Well, we have a drop off in volume, then an increase in volume. So volume confirms it's bullish. We have a lower low, a higher high, and we are over the previous monthly high. That's a trap by definition. And we're over the previous monthly high. So as long as we remain over, I would say 315. And right now, that's about a 2% cushion. Things don't look so bad. Things could go lower. We could retest the roughly 290 area on the monthly. I could see that as a logical point for us to go to, but it's not going to happen unless we're below 315, because the probability is that we can squeeze higher if we hold this area. Closing at the high of the month also implies upside momentum, which should lead to continuation. So if now we think about the bull scenario was just that we want to make sure we maintain higher lows. We want to play defense. And if it's time to leg up again, like the psychology chart shows us, as I laid out earlier, we want to make higher lows and higher highs. So if we look back here now, for this pattern to play out, first of all, we cannot revisit the lows. We cannot make a new low. Otherwise, we're not carving out a sideways action where right now we're currently at the midpoint. The midpoint is not correct if it's not the bottom. So again, just making it a little bit more close here. If we're drawing it, this is not the start of the reversal or the mean reversion, right? Or symmetry, where we're going to repeat this part of the pattern on this half, which means just going back up. So if we don't form higher lows, we're not playing defense. So we have a lower low last month, but then we have 1, 2, 3, 4 off the low. So the low looks pretty solid, but as we're carving out this next portion here, we could go sideways. And I just want to make sure we hold that higher low. So that's going to be at 285. It also make sure we're going to maintain our 50 MA on the monthly or our short-term price. And if the NASDAQ is leading, this is very important. We want to see higher highs and higher lows. So we're likely going to form a higher high right around the opening of April. Seasonality tells us that. And we're closing out within, I don't know, like 20, 30 cents of the high of the month. So it's very likely we're going to get above there. The question is whether or not we're going to hold it. So if we don't hold it, that's a failed breakout. It's short-term bearish until we get back above the high. So make it really simple for me. If we're green on the month, it's bullish. If we're red on the month, it's bearish. It's that simple. All right. Now we think about the potential here, we talked about the most bullish thing we have going forward is the bears. The market is basically telling you that the rate cuts later this year are going to support higher multiples, and we're not convinced those cuts are going to come. The markets are misreading the Fed. So the market's fighting the Fed, but it's winning. So what does that really come down to? Well, it comes down to select smart money fighting it out, and then retail jumping into the mix because they love the NASDAQ. Veteran money managers bail on stock rally with Fed hawks flying. So these are firms which manage, let's just make sure we look here. I think it was 1.4 trillion was one of them, right? LNG, Legal and General, never heard of them before, which manages 1.4 trillion, has cut its equity exposures down to the biggest underweight since the lockdown, concluding that the hit from the aggressive tightening will continue to play out in the U.S. economy for months to come. After the bank turmoil this month, asset managers shifted their stock exposure from close to neutral to a level halfway towards historical levels. Low underweight measures, and they're overweight bonds right now. Market implied estimates may be exaggerating rate cut potential before the year end. They're favoring defensive positioning and bonds, right? Those nice, silly, boring, predictable bonds. So here is where I'm looking at the S&P. I laid out so this is also another monthly chart. So this is important because it gives me a different perspective. So the bullish perspective is that QQQ is going to lead us to infinity and beyond. It's going to drag the whole market higher. And it's that simple for me. On the flip side here, oh, crap. I did this chart here, and I'm going to post this on Twitter later. So there's a link in the description if you want to follow me. But what this pretty much shows me here is SPY on a 1-month log scale chart with a line chart. What this pretty much means is that I'm trying to replicate the psychology chart over top of the S&P and then ask myself, okay, is it close enough? Is history rhyming? Can I get a repeat of what could come next? Oh my goodness, I don't like this. Why? I don't like it because it tells me that this portion right here, the hope, optimism, belief, thrill, euphoria, looks pretty accurate. This goes back to roughly 2018 as well, the last Fed tightening cycle. 2020 wasn't really a tightening cycle, but that's why we have these lows here. So, right, we chop up, chop, boop, go to euphoria. We're all geniuses. All we got to do is YOLO, AMC, GME, Bitcoin. Let's go. And then we come down to a double cut. So here we know there's a double cut on the psychology chart. There's a double cut on the blue line chart. So we come down, bounce back up. And I think right here, I'm trying to ask myself, what are people saying right now? Oh, well, I'm kind of saying the same thing, right? We have to just cool off before the next big rally. Yeah. And only last year, if we look back here to, actually just want to pull this up because we can overlay them to see, and this is on a monthly time scale. So please just note, like, this does not move fast. This moves like really slow. And if we look here to this post from before, we go down the slope of hope where people are just continuously bullish. Oh yes, tech going to bounce back. And then we climb the wall of worry. So as we climb the wall of worry, there's things to worry about, but at a certain point, momentum starts coming in. Momentum players, right? Profit takers, performance chasers, premature eradicators. What happens? Complacency. Oh my God, I guess we can't go down. Stonks only go up. New bull market, 20% off the low. And then, boop. And the reason why I find this one interesting is because I wasn't actively trading much at the time. My market knowledge was limited, but by listening to the commentary over the weekend, what I heard was that Bear Stearns and the Lehman Brothers were 6 months apart. So 6 months, that's a long time from the first one to the last one. Sorry, from the first one to the big one. So we just got SVB, and 6 months out is pretty much 2 quarters, which is when I start to get worried about the potential for a recession. I'm not going to go through that in this video to keep it a little bit shorter, but that's how I could see the bears being fundamentally correct, but their positioning is off and their timing is off, even though the Fed is on their side. That's what it really comes down to. All right. If we now go back here to our CFTC net positioning here, I want to show you one more thing because this is important. And again, please make sure to stay tuned for a few more minutes. I will go through some key levels. So if we look back here to June, we're looking at the S&P specifically. So this is the S&P 500 futures speculative net positioning, which means people betting against the market. And it happened pretty much starting in June. So if we understand the psychology, in addition to the positioning and everything else, what does it tell us? Well, as you can probably see here, this is a monthly chart on SPY, increasing bull volume. And what I'm pointing out here is that the area that's currently circled, man, why does it look all funky here? Maybe they made an update. Okay, what's going on? We can note here that this is June. So this month I've circled right here is June. And this is where we are right now. This is where we are right now. So the high for June, 41744. Okay. What's our high last month? 41831. Okay. And then what's our high right now? 409.7. Yes. Why is this so important? Because 417.8 is where we birth a bull market on the S&P 500. So if S&P can just manage to go up like another 2%, 3%, we're going to be in bull market territory. We're going to be over anyone who shorted this. We talked about how 4020 on ES was the median price for the short positioning. Now we're at 4130. We're 120 points higher. This is painful. This is extremely painful. It's why they won't give up. It's why they're doubling down, adding down. And it's been almost a year now. So if we now think about this very logically, if I was on Team Bear and now I'm not only, I was big green, by the way, green, big. Okay. I come back to break even. Okay. Add more. Come back down, come back up. Oh my God. Now we're back to break even. And now if we get above 417, 418, call it 420, what that means is that we're actually in a period where we're now above the area where anyone who went net short is losing money. Why? Let's look at the positioning again. Went from net long to net short. The page will load. So we're net long here at the June 16th. We're net long. Boom, net short starting on the 24th of June. Okay, so like in like an instant, it goes short. So we were long, net long up until this point. The people betting against the market. If we punch over this area, first of all, we stop going down on the monthly, significant, and then also anyone who shorted it is red. That's called a bear trap. It's called a bear squeeze. It's called a short squeeze rally. That's what it is by definition. Is it fundamentally the healthiest market? I don't know. We'll find that out in hindsight. So there you go. All right. And then what do we have coming up this week, which could drive the market? In terms of economic data, we've got nothing really happening. There's a little bit of data, ISM, JOLTS. What I'm focused on is going to be ADP because we're going to be closed on Friday. It's going to be a good Friday. If we get a weekend, we get a long weekend. Hell yeah, right? Let's go. On Wednesday, we're going to get an ADP non-farm payroll print and ISM manufacturing. And then what I'm looking to most importantly here is going to be the non-farm payroll coming in on Friday. But I'm not sure. I'm not sure actually because this doesn't happen very frequently. Whether the data is actually going to be released on Friday when the market's closed, or if it's going to push to the Monday, or if it's going to move to the Thursday. I don't know. I think we'll find out as the week progresses. But this is going to be very important, and it's important because if this actual forecast comes in for non-farm payroll, we're actually starting to add less jobs. Larry Summers said below 250K is constructive. And 238 is less than that. Unemployment's not ticking higher yet, but that would be right after we start seeing non-farm payroll stop getting added at the same rate as before. Let's just make some sense of this chart. Let's remove the lockdown. Okay, so these numbers appear to be coming down. Yeah, so 250, 260, 500, 300. Okay, well, we're coming back down to an area where it appears like this would be the second smallest print in second smallest print in a year. So that's what the Fed wants to see. It's a leading indicator. It's not going to tell us for sure what's happening. All right, let's go through some levels. So now that we've looked at both the monthly chart for SPY and QQQ, I think the story is very clear. Please make sure to drop me a comment and tell me what you think if you've watched all the way till now. And now we're going to flip over here to the weekly charts because remembering that the monthly chart is formed by 4 weekly candles. So if the levels are very clear on the monthly, because it takes 30 days basically for a new candle to form, is the weekly chart giving us any clues? We talked about 30512, which is the birth of a bull market for the NASDAQ. We have volume ramping up in legs here. It looks bullish to me. And we also have to be mindful of this 32697, which means we are now also below the 20% off the highs. 32797 means we are 20% off the highs. And then the last thing we have to battle with is going to be that relative high going back to August, which was that trap we showed you earlier in the year where it just faded. And I know earnings are coming up in about 2 weeks, but because next week is closer than earnings in about 2 weeks when banks report, we're going to focus on the tech story this week. We will pick up on banks next week. So again, please make sure to subscribe if you want to make sure you're able to see all of those updates. All right. So for QQQ, I would say that we have to be bullish. We want to make sure we play solid defense now. Solid defense means that we cannot come below this weekly low. We can come all the way back down to 304, but we cannot lose it. Remembering the levels from the monthly we just talked about. So what I would ideally like to see, we're nearly at a gap fill here. So the low on the gap going back to August is 32208. Our high the next week, 32151. We're off by about 50 cents. It's almost all also exactly where we stalled out, that high. So if we can get through this high at about 321.6, that means we should, again, keyword being should, be able to squeeze to 334, which is our relative high. And if the bear fill is going to continue, like it should be immediate. There was a huge push on Friday. So there you go. That's QQQ. If we backtest, I do not want to see 315 violated. If that happens, the weekly chart is still bullish. We're over both averages. We could be coming all the way back down to 305, but that would be a yellow flag by falling back below 315 based on the monthly and annual chart. All right, then looking over here to SPY. Looking here to SPY, we're now going to actually clean the chart up a little bit. These yellow boxes are invalidated, and we actually bounced exactly off the area we had to reject in order to validate this bear market at 393.6, which we have covered in previous videos. 39364, our low this week, 39369. What does that mean for S&P? Let's remove everything to make it simple. I don't want to see a lower low. Why? If we go to a lower low, it means we are going below the 50 weekly moving average as well. Also, I do not really want to see us fall below 407.45. Why? Because on the monthly chart, we're not even in a monthly higher high. We have a higher low and a lower high. We have to get through 418 ASAP. So if we're not able to claim that area, and we also fall below 407, well, we're probably coming back down for some kind of back test to 400, maybe to 395. I'm not sure. So if we're looking for immediate continuation, let's be looking for that. We also have a gap down with a massive capitulation flush in volume. And if we look here, 2018, 2020, that's the blue line. That's what we're flirting with right now. It's at about 410. So we've stopped going down by claiming the red downtrend. We've gone up 20% roughly 2 times. But what's missing here is that we didn't really start going back up. This is a very, it's not an acute uptrend. It's a very slow, it's a very easy uptrend to hold. If we're able to rock back above this blue uptrend by just pivoting bullish, it means we're reclaiming a multi-year uptrend. That is very significant. So let's make sure we're receptive to the levels. And with that said, I want to thank you so much for watching. And if you want to see more, you can watch our weekend review from last weekend, which I think was a great tee up for this week. If not, thank you so much for watching, and I look forward to seeing you on the next one.